Fintech revolutionizing finance in Kenya. The landscape of financial services in Kenya has undergone a significant transformation in recent years. Fintech is short for financial technology. It encompasses a wide range of applications and services that leverage technology to improve financial activities. It's about using technology to make financial services better and easier to use. From mobile banking apps that allow you to manage your finances on the go, to online lending platforms that provide quick access to loans. Think mobile banking apps, online lending platforms, and even cryptocurrency exchanges. These innovations are making financial transactions more convenient and accessible. In Kenya, fintech is a big deal. The country has become a leader in the adoption of financial technology, setting an example for other nations. Millions of people use mobile money platforms like M-Pesa every day. This service allows users to send and receive money, pay for goods and services, and even save money, all through their mobile phones. This technology has transformed how people send and receive money, pay bills, and access financial services. It has brought financial inclusion to many who were previously unbanked. Fintech is important for a few reasons. It not only provides convenience, but also opens up new opportunities for economic growth and development. It makes financial services more accessible, especially for people who don't have traditional bank accounts. In rural areas where banking infrastructure is limited, mobile money has become a lifeline. It can also make financial services more affordable and efficient. Lower transaction costs and faster processing times are just some of the benefits. However, with new technology comes new challenges. Issues such as cybersecurity threats and data privacy concerns need to be addressed. This is where regulation comes in. Effective regulatory frameworks are essential to ensure that fintech innovations are safe and secure for all users. Guardians of the fintech frontier, key regulatory bodies. In the rapidly evolving world of financial technology, regulatory bodies play a crucial role in maintaining order and trust. They are the unsung heroes, ensuring that innovation does not come at the cost of consumer protection and financial stability. Kenya has several regulatory bodies that oversee the fintech industry. These bodies ensure that fintech companies operate fairly and responsibly while protecting consumers. They set the rules and guidelines that fintech companies must follow, ensuring a level playing field for all market participants. The Central Bank of Kenya, or CBK, is the big boss when it comes to financial services. They regulate banks and other financial institutions, including those involved in mobile money. The CBK's role is pivotal in maintaining monetary stability and fostering a sound financial system. They also work on policies that promote financial inclusion, making sure that even the unbanked population has access to financial services. The Capital Markets Authority, or CMA, regulates capital markets, including crowdfunding platforms and other fintech companies involved in securities and investments. The CMA ensures that these markets operate efficiently and transparently, protecting investors from fraud and market manipulation. They also encourage innovation in the capital markets, supporting new financial products and services that can drive economic growth. The Insurance Regulatory Authority, or IRA, oversees the insurance sector, including Insurtech companies that are using technology to innovate insurance products and services. The IRA's role is to ensure that insurance companies remain solvent and can meet their obligations to policyholders. They also promote consumer education, helping people understand the importance of insurance and how to choose the right products for their needs. The Communications Authority of Kenya, or KK, regulates the telecommunications sector, which is important for mobile money and other fintech services that rely on mobile networks. The CAK ensures that telecom companies provide reliable and secure services, which are essential for the smooth operation of mobile-based financial services. They also work on expanding network coverage to rural areas, helping to bridge the digital divide. These regulatory bodies work together to create a framework for fintech innovation while safeguarding the stability of the financial system. By collaborating, they ensure that the fintech ecosystem in Kenya can thrive, driving economic growth and improving the quality of life for all citizens. Their combined efforts help to create a balanced environment where innovation can flourish without compromising on security and fairness. Mobile money and digital credit. Balancing innovation and protection. In today's fast-paced world, the balance between fostering innovation and ensuring protection is more crucial than ever. Mobile money is huge in Kenya. It has transformed the way people handle their finances, making transactions more accessible and convenient for everyone from urban centers to rural areas. M-Pesa, launched in 2007, revolutionized financial inclusion. This groundbreaking service allowed millions of Kenyans to participate in the financial system, many for the first time. It allowed people to send and receive money using their mobile phones, even without a bank account. This innovation bridged the gap for those who were previously unbanked, providing them with a secure and efficient way to manage their money. Digital lending platforms have also become popular. These platforms have emerged as a lifeline for many, offering financial support in times of need. These platforms offer quick and easy access to small loans, often through mobile apps. They provide a convenient solution for those who need immediate financial assistance, bypassing traditional banking hurdles. Regulation is crucial for mobile money and digital lending. Without proper oversight, these innovations could lead to financial instability and consumer exploitation. The CBK has issued guidelines for mobile money providers, focusing on consumer protection, anti-money laundering, and combating the financing of terrorism. These measures ensure that the financial ecosystem remains safe and trustworthy. The CBK also regulates digital credit providers to prevent predatory lending practices and ensure responsible lending. By setting clear standards, the CBK helps maintain a fair and transparent financial environment, protecting consumers from potential abuses and fostering sustainable growth in the digital financial sector. Insurtech and WealthTech, expanding financial inclusion. Insurtech uses technology to make insurance more accessible and affordable. This is particularly important in emerging markets like Kenya, where insurance penetration is low. WealthTech, on the other hand, uses technology to provide automated investment advice and portfolio management services, often through robo-advisors. The IRA is working to create a regulatory sandbox for Insurtech companies. This allows innovators to test new products and business models in a controlled environment before launching them to the wider market. The CMA is also developing regulations for wealth tech companies to ensure that they operate transparently and provide suitable advice to investors. Fintech relies heavily on data. This raises concerns about data privacy and security. Kenya has data protection laws in place to address these concerns. The Data Protection Act of 2019 outlines the principles of data processing, including requirements for consent, data minimization, and purpose limitation. The Act also establishes the Office of the Data Protection Commissioner, which is responsible for enforcing data protection laws. This is crucial for protecting consumer data in the fintech space. Cryptocurrencies like Bitcoin and Ethereum have gained global attention. However, Kenya's stance on cryptocurrencies remains cautious. The CBK has issued warnings about the risks associated with cryptocurrencies, including their volatility and potential for illicit activities. Currently, there is no specific regulatory framework for cryptocurrencies in Kenya. The government is still assessing the potential risks and benefits before developing a comprehensive regulatory approach. Central bank. Digital currencies, or CBDCs, are essentially digital versions of a country's fiat currency, issued and backed by the central bank. The Central Bank of Kenya, or CBK, is currently exploring the potential of a CBDC in Kenya. A CBDC could potentially enhance financial inclusion, improve the efficiency of payments, and reduce the costs associated with cash. However, the CBK is proceeding cautiously, considering the potential implications for monetary policy, financial stability, and the existing financial infrastructure. As fintech continues to grow in Kenya, regulators face the challenge of fostering innovation while mitigating risks. Here are a few recommendations for the future. Regulatory bodies need to work together to create a cohesive and adaptable regulatory framework for fintech. Regulations should be proportionate to the risks posed by different fintech activities. A one-size-fits-all approach may stifle innovation. It's important to educate consumers about fintech products and services, their rights and potential risks. Sandboxes provide a safe space for fintech companies to test new ideas and business models under regulatory supervision. Global collaboration is essential to address the cross-border nature of fintech. Fintech has the potential to revolutionize finance in Kenya and beyond, driving financial inclusion and economic growth. However, it's crucial to embrace this revolution responsibly. Regulation plays a vital role in finding the right balance between fostering innovation and protecting consumers. By creating a supportive yet robust regulatory environment, Kenya can harness the power of fintech to create a more inclusive and dynamic financial system. Kenya stands at the forefront of the fintech revolution in Africa. Its experience offers valuable lessons for other countries navigating the complexities of regulating this rapidly evolving industry. By embracing innovation while prioritizing consumer protection, Kenya can pave the way for a new era of financial inclusion and innovation, transforming the lives of millions.